Hey everyone, FinTech here, and in this video I'm going to be going over my top stocks for April 2020, looking at the companies I think have the best chance of having a very positive return over the next 2 to 5 years. Now up until this point this year, the stock market in general has been trending negative, especially high growth technology stocks like those I tend to invest in. In fact, many of the stocks that I'm currently holding are down 30, 40, or even 50% since November 2021. But while it is unfortunate that the stock prices of many of the stocks that I hold have declined in value, I think that the price of the stock does not necessarily match the value of the companies, and that the value of many of these companies is higher than it ever has been before. So while yes, I would have been better off completely selling out of my portfolio last November and then buying in right at the bottom in around January, I personally am no good at timing the market, and I would much rather focus on investing in good companies that I think are changing the world, either through introducing a new technology, a new business model, or are just growing so quickly that they are going to take over their market in the next couple years. So if you're interested in those kinds of companies, this video is going to be for you. We're going to start by talking about my portfolio in general, then look at the specific companies in my portfolio, and then finish up with any trades that I've made in the last month or so. So if we look at my Charles Schwab portfolio and sort by just the last month, we can see that it has declined by around $43,000, or around 21% in just the last month. Now, while that does look pretty bad, it's actually down around the same amount over the past 3 months as it is over the past 1 month, which basically means the portfolio is essentially flat from where it was in January, and most of the decline in my portfolio really dates back to that big drop between November and January of 2022. Now, as nice as it would have been to say sell out of the market here on December 27th and then bought back in on January 27th, there's no way I could time the market like that. Although one thing that I can use that comforts me a little bit is if I go to the 1-year view, I actually do still have a positive return over the past year, and if I look at over 2 years, I have around an 80% positive return in my portfolio during that time. Now, Charles Schwab shows this as 360%, but that's because that also includes money that I've added to the portfolio during the last 2 years. But looking at this stuff is really just for fun. Let's actually get into the individual stocks in my portfolio that I think are going to do the best going forward. So let's start with my largest position overall, which is Datadog. Datadog is currently a $49,000 position for me, and that's off a cost basis of $35,000. So it's made around $14,000 or 50% return. Datadog makes it easy for companies to unite their applications, their infrastructure, and their security all through a single pane of glass. And as companies start to produce more and more data and more companies move into the cloud, this service becomes more and more valuable every year. And this is really clear in Datadog's numbers, where this company has grown at well over 50% growth in terms of its revenue every single year like clockwork for several years at this point. So the company is growing well, they have a technology that makes sense, and they're sitting in an industry that is only going to keep getting better. So this company really meets the trifecta of things that should set it up to grow extremely quickly in the future. After Datadog, we have Cloudflare, which for me is a $23,000 position, and that's off an initial investment of around $16,500. So it shows here I have a gain of around $6,000, but that's also because I have sold some of my Cloudflare position, and the way Charles Schwab calculates your gain and loss is based on a first in, first out basis. So those shares of Cloudflare that I bought 2 years ago for a really cheap price, I sold, and so the remaining shares are shares that I bought at a little bit of a higher price. So in reality, my gain here, I believe, is still over a 100% return overall. Now, one other thing you might notice here is that there's this rating from Charles Schwab which says that this stock is a D rating. To be honest, the entire time that I've owned Cloudflare, Charles Schwab has been rating it as a D or an F. I really don't know where they get these ratings from, but they're not at all accurate in terms of where the stock price is going to go next. And if it was, everybody would just put their money into Charles Schwab and follow them. So really, I wouldn't put a lot of weight onto these ratings. What Cloudflare does is try to make the internet itself work better. They started out as just a CDN service, essentially hosting websites. Then they added on firewall capabilities to protect those websites. But then they realized with all this traffic coming in and out of their network, they could analyze that traffic to not only block bad actors, but also optimize the entire thing for good actors. So over time, they use this data to build on more and more products over time. And at this point, they are actually offering similar services to a large cloud provider like Google or Amazon or Microsoft, which basically would have been unthinkable a few years ago that a startup could compete with those 3 behemoths. Of all of these companies, Cloudflare is probably the most innovative overall in terms of the number of new products that they launch every single year, and that's why it's my number 2 largest position. But if you're interested in investing in stocks and you want to make an instant return in the next 5 minutes, let me tell you about Webull. Webull is currently offering a program where if you sign up, they will give you 2 free stocks. Then if you deposit any amount of money, they will will give you 3 additional stocks valued at a minimum of $27 and potentially worth all the way up to $9,600. On top of that, when you trade at least $1 with Webull Crypto, you'll get $5 in free crypto from them. So click the affiliate link in the description and sign up with Webull to get that free money. It is literally free money. And let's continue with ZScaler. After Cloudflare, we have ZScaler, which is currently a $22,000 position for me, and that's actually off an initial investment of $27,000. So this is the first position I have that's actually lost money. Now, ZScaler is essentially a security company. They specialize in zero trust security. If you imagine sort of a traditional security company, what they do is they try to protect the outside of a company to keep any bad guys from getting in. The only problem is, once a bad guy does get in, they kind of have free reign to spread from one computer to another and take over the whole thing. With zero trust security, each individual application has to be authenticated with any other thing it wants to connect with. So even if a bad guy gets inside your network, they can't do anything unless they individually hack into every single app on your network, which is way harder to do and makes it a lot easier to maintain security, especially on, say, cloud workloads. Zscaler, similar to Cloudflare or Datadog, is growing extremely quickly, and like those two other companies, they're in an industry, in this case security, that is only going to keep getting bigger and bigger as more companies move to the cloud. So this is why it rounds out my third largest position. After Zscaler, we have Upstart, which is now a $14,000 position for me, and that's off an initial investment of $32,000. So this has lost more than 50% overall. Now, what Upstart does is try to apply AI to solve the lending problem. Now, historically, when you're lending to someone, you determine whether or not they're worthy of getting a loan based on their credit worthiness, which you determine based on a single number, their credit score. Well, what Upstart does is take this single number and replace it with thousands of different parameters that can be fed into an AI model. This allows them to offer cheaper loans to people who have good credit scores, or even offer loans to people who wouldn't ordinarily qualify for a loan. Now, Upstart has seen a huge drop in their stock price since I first bought into them. In fact, I think it's probably my worst performing stock overall. At the same time, the underlying value of the company is intact. A few quarters ago, they showed a huge slowdown in their growth rate, which caused the stock price to drop dramatically. And then just last quarter, they re-accelerated their growth, and yet they didn't see a corresponding rise in the stock price. Now, there are some risks with this company because it is a financial services company, so interest rate risk is always present. But at the same time, Upstart's product has proven to settle more loans and have a better conversion rate than other products out there. So from a company perspective, it's doing well. It's just from a stock price perspective, it's not really reflecting that at this point. And because of that, I actually bought more Upstart recently because I do think this company is overvalued relative to where they're going to be 2 or 3 years from now. After Upstart, we have CrowdStrike, which I currently own $14,000 worth of, and that's off an initial investment of $9,000, so it's made around $5,000. Now, in reality, CrowdStrike, like some of my other companies, I've sold a lot of kind of recently. CrowdStrike used to be my largest position overall. Now, CrowdStrike offers one of the best security platforms in the world, the Falcon Endpoint Protection Platform. They are a cloud-native cloud security company, which means their product better addresses security in the cloud than traditional cloud security companies. Now, up until now, CrowdStrike has been one of the fastest growing companies in the entire world, posting above 80% growth rates pretty consistently for multiple quarter after quarter after quarter. Now, more recently, their growth rate has slowed somewhat into around the 60% range, which is still very, very impressive, especially considering the size of CrowdStrike. But if this trend of slowing growth continues, it makes sense for me to trim the size of that position somewhat and redeploy that money into some higher conviction positions I have, or just to diversify it a little bit, which is why I've shrunk my CrowdStrike position to more of a mid-sized position from one of the larger positions. After CrowdStrike, we have ZoomInfo, which is currently a $10,000 position, and that's lost around $1,600 off of an initial investment of just under $12,000. Now, ZoomInfo is a company which a year or two ago you probably would not have heard of, but if you've ever Googled someone's name more recently, you may see them come up in search results. What ZoomInfo does is make it easy to contact people at the companies that you need to communicate with in order to sell them something. So it's a win-win because the salespeople can talk to the people at the company they need to get in contact with, and it's a win for the company because they're reached out to by people who actually have products that help them. Now, ZoomInfo is also fundamentally a technology play, and they are growing very quickly, and so that's how they've won a mid-sized position in my portfolio. Now, next up, we have Sentinel One, which is a relatively newer position for me. Sentinel One is currently an $8,500 position, and that's off an initial investment of $12,800, so also down pretty dramatically. Now, Sentinel One does fundamentally the same thing as CrowdStrike. They offer cloud security services, and in a lot of ways, they look like CrowdStrike did 3 years ago. They're growing at well over over 100% revenue growth per year, and they're starting to slowly increase their margins to match those of CrowdStrike. If they can successfully get this working to the point where they're running at the same kind of margins as CrowdStrike, I think this company could have a lot of potential to grow in price very, very quickly. So this one I would say is a little bit more speculative than some of my other positions, but I clearly believe in it enough to put $8,500 into it. So it's a little bit of a higher conviction, yet still speculative position. After Sentinel One, we have C Limited, which is now a $2,500 position, and that's off an initial investment of $5,600. So it's lost more than 50% of its value overall. Now the reason for this is C Limited has three fundamental businesses. There's Garena, their gaming business, there's Shopee, their e-commerce business, and there's C Money, their financial services business. Now Shopee specifically, because it's involved in e-commerce, has been hit super hard by the supply chain issues over the past couple years. Unfortunately, they don't have the same kind of scale as an Amazon or an Alibaba to control their own supply chain, and so it's kind of a rough time to be an e-commerce company. At the same time, C Limited has demonstrated that they are a really impressive company. They've basically taken over all of e-commerce in Southeast Asia, and they've also expanded aggressively into both Brazil and Mexico. Now, in the short term, as long as supply chain problems continue, I don't see C Limited catching up with their previous price anytime soon. The fact is the headwinds are pretty strong. At the same time, once the supply chain issues do ease up, I think the unrealized potential of C Limited could be unleashed, and this stock could very, very quickly double or triple in price. The only problem is we don't know when that's going to happen, so this is going to stay as a smaller position for now. After that, we have SoFi, which I've talked about a lot on this channel. SoFi is currently a $1,400 position for me, and that's off an initial investment of $3,000, so also a 50% decline. Now SoFi I've actually been adding shares to recently, as it's recently hit its lowest price since it first went public. Now SoFi has ambitions of taking over the entire financial services space, basically becoming the fintech company, and they've started to make a lot of progress into this area. They use their financial services, so things like the SoFi app or SoFi Investing, as sort of a top of sales funnel, and then they funnel their users down to more and more valuable products in the ecosystem, like lending for student loans or mortgages. This alone, I think, justifies SoFi's current valuation, but there's also a whole other segment of their business that I don't think the market is valuing, which is their Galileo technology platform. Now their technology platform allows them to do things like processing payments for other banks or running credit card transactions. And it's on this platform I think SoFi is going to build a true fintech company, a technology first company that can act as the backbone for all financial services. Imagine not having to wait 3 to 5 business days to transfer a check to your bank. You can get that money instantly as long as that bank is associated with SoFi. If you check out some of my recent videos on SoFi, you'll see that they've had some major acquisitions in this area, and they are clearly investing a lot of money into building this platform. Now we don't know 100% that they're going to win the race to become the best fintech, but I think that it's worth putting some money into that bet because SoFi overall has not missed in terms of their company performance. The stock price is pretty disconnected at this point, but I think that in the long term, the stock price will reflect the underlying value of this stock. And then to wrap up, we have Amplitude, which is currently just a $1,000 position for me, and that's down, 66% from an initial $3,000 investment. Now, when Amplitude first started out, its founders were actually working on founding a different company, but they realized they needed a tool to analyze their app to see when users were clicking off the app, what actions could cause the user to buy more things within the app, and other kinds of advanced analytics like that. The problem was that platform didn't exist, so they went ahead and built it, and they built up the company called Amplify. Amplify kind of follows the same idea of Datadog. I think analytics are going to become more and more important as companies start to realize the huge value that's present in them, but this is still a relatively small position for me, and it's probably going to stay that way until I gain more conviction in this company or I sell out completely. But let me know if you hold any of these 10 stocks in your own portfolio or if there's a different company I should look at. Don't forget to like and subscribe, and I'll see you next time.